Ray Dalio's 2010 Euro short details, breakdown of 1 billion, bet from 23%, loss to 45% profit. Hi my friends, welcome to ZC's Finance channel. This is the 13th episode of our 5-minute financial series. Last time, we broke down Buffett's shrewd Goldman Sachs negotiation. Today, we shift to a legend who lives by data, Ray Dalio, founder of Bridgewater Associates, and his 2010 Euro short that tested the limits of discipline. What made this trade a masterpiece? It wasn't just a 4.5 billion profit, it was how Dalio turned a 6-month, 2.3 billion loss into a win by doubling down on his debt cycle framework. With operational details so precise they're still used at Bridgewater today. Let's unpack the hidden research, position calibration, and loss management rules most summaries skip. First, the 3-layer cycle analysis that built the case. By early 2010, the Eurozone's economy seemed steady. But Dalio's team spent 4 months digging into 3 interlocking cycles: debt, political, and currency. They mapped monthly debt data for 12 Eurozone countries, finding 1. Greece's hidden debt off-balance sheet loans from banks added 15% to its official 127% debt to GDP ratio. 2. Italy's tax collection rate had dropped to 68%, meaning it couldn't repay debts even with austerity. 3. The euro's exchange rate was overvalued by 18% compared to its fair value, calculated by Bridgewater's trade balance model. Dalio told his team, "The Eurozone is a house of cards. The single currency forces weak countries to borrow in euros, but they can't print euros to pay back debt. That's a crisis waiting to happen." He set a target. The euro would drop to 1.2 by mid-2011, and he planned a 10 billion bet to profit from it. Next, the phased position building to avoid market alarms. From March to May 2010, Dalio didn't just buy euros to short, he built a hedged basket across 6 European currencies, with strict rules for each. Step 1. Allocate 6 billion to euro short positions, 60% of the total bet, using 2:1 leverage borrowing, RPAR 12 billion to control 18 billion in euros, to amplify returns without overexposing Bridgewater. He used forward contracts with 5 global banks, UBS, HSBC, to lock in exchange rates, never more than 1 billion per bank, to avoid tipping off competitors. Step 2. Add 2.5 billion to Italian lira shorts, 25% of the bet. The lira was pegged to the euro then, but Dalio's team saw Italy's debt risk as higher. They bought put options on lira, euro futures, with a strike price of 0.85, meaning they'd profit if 1 lira bought fewer than 0.85 euros. Step 3. Allocate 1.5 billion to Spanish peseta shorts, 15% of the bet, focusing on short-term 3-month contracts to quickly adjust if the market shifted. Then came the 6-month stress test, and Dalio's strict loss rules. By July 2010, the euro had risen 7% to 1.49, and Bridgewater's position was down 23%, 2.3 billion. Critics called Dalio out of touch, and 2 senior traders asked to cut losses. But Dalio had preset rules. 1. If the loss stayed below 25%, don't exit. His model's confidence was still 80%. 2. If Greek debt to GDP rose above 140%, add to the short. 3. If EU leaders agreed on a 500 billion plus bailout, rethink the bet. In August 2010, Greece's debt hit 142%, and the EU's bailout plan was only 110 billion. Dalio saw his chance. He added 2 billion more to the euro short, buying put options with a lower strike price, 1.3, to profit more if the euro dropped further. "We're not betting against the euro, we're betting on math," he told his team. The trigger moment arrived in November 2010. Greece admitted it had underreported debt by 3 billion. And S&P downgraded its credit rating to BB+. Yunk. Panic hit. By December, the euro fell to 1.3, and Italian lira futures dropped 9%. Dalio didn't cash out. He used a trailing stop, selling if the euro rose 3% from its lowest point, to protect profits while letting gains run. By March 2011, the euro hit 1.25. Dalio sold 40% of his euro forward contracts, locking in 1.8 billion. In July 2011, when the euro dropped to 1.2, his original target, he sold the rest, 2.7 billion from euros, 800 M from lira, and 200 M from peseta. Total profit, 4.5 billion, a 45% return on the 10 billion bet. The real lesson? Dalio's system over emotion. He didn't rely on gut, he built a framework with clear entry, exit, and adjustment rules. Trading isn't about being right once, he later said. It's about having a system that works over time, even when it has bad streaks. Bridgewater still uses this playbook today. Analyze cycles, build hedged positions, and stick to preset rules. If you love this deep dive into Dalio's data-driven discipline, hit like and subscribe. Next episode, episode 14. We're focusing on Paul Tudor Jones II, one of Wall Street's greatest crash predictors, and his 1987 Black Monday short. We'll unpack how he used Elliott wave theory to spot the stock market's 5-wave rally, a sign of an impending crash. Built a 1.5 billion short position in 14 days using S&P 500 futures and stock puts, and turned 100M into 1.1 billion in 3 days. All while most investors thought the bull market would never end. Subscribe now. You won't want to miss how Jones turned a historic meltdown into a career-defining win. Thank you.